Our Allodium webinar presentation on how to use the bucket strategy to accelerate impact investing. We're happy that you set aside some time to join us today, and we hope to provide you with some practical information that you'll find useful. I'm David Brummelkamp with Allodium Investment Consultants in Minneapolis, and I'll be your host for today's presentation. We've budgeted 90 minutes for today's presentation, which will consist of a 60-minute formal presentation, followed by a 30-minute question and answer period. You're welcome to ask questions via the chat room function on your Zoom application, and we'll try to address those questions in the question and answer session. The idea for this presentation came about as we've observed that many Allodium clients have been asking for help with impact investment strategies and solutions. I personally have started to build out a portfolio of impact investments for myself over the past few years. And so I've been learning how to increase my exposure to high impact investments in the context of a holistic view to personal financial planning. Learning how to better access impact investments over the past few years, Allodium has started to identify the best ways to add these types of investments into portfolios. The Allodium team has developed this educational presentation to give you an overview of some practical ideas to help you to accelerate an impact investment strategy. Just a note that this presentation is an educational presentation about impact investing, and it's not intended to be specific investment advice. Also, Allodium is not providing legal or tax advice in this presentation. Our speakers today will consist of four of the members of the Allodium Investment Committee. Today we have Derek Van Callaghan, Eric Hutchins, Saul Bauman, and myself. Our fifth member of the Investment Committee, Suzanne Tudor, was not able to attend today's session. She had a family emergency, and so she's off doing something with her family today. But we hope you enjoy the presentation. And now I'll turn it over to Derek to provide you with an outline for today's discussion. Derek?
Thanks for that introduction, Dave. And I still see some attendees trickling in here, and I just want to thank you all for attending today. We're going to be covering a number of different topics during our presentation this morning. As a starting point for our discussion, we're going to have our Chief Investment Officer, Eric Hutchins, educate everyone on the bucket strategy that we utilize with our investment management clients. After our overview of the bucket strategy, Eric will continue into describing the nuances of sustainable and responsible investment, otherwise known as ESG or SRI investing. One form of sustainable and responsible investment that is often overlooked is called impact investing. Eric will spend some time educating us all on what impact investing is and how it differs from the traditional ESG or SRI investing that most investors are aware of. During the third part of our presentation today, Saul and I will be giving some examples of impact investments that individual investors can utilize in each of their so-called buckets. To wrap up the presentation, Dave and I will have a discussion on some of the impact investments that he has made over the years as examples and what it was that originally drew him to this type of investing. So without further ado, I will turn it over to our Chief Investment Officer, Eric Hutchins, to discuss the bucket strategy.
Thanks, Derek. So what is the bucket strategy? It's a straightforward approach to wealth that includes all of the investable assets on your net worth statement. Working with your investment advisor, you choose the appropriate allocation to each bucket because determining the right mix is very specific to each investor's individual situation, time horizon, and goals. Here's the big picture overview of the bucket strategy. As you'll see, there's 4 buckets, each with its own purpose, time horizon, and degree of risk. The 2 blue buckets on the left-hand side are more conservative and are for current spending and short-term goals. The 2 tan buckets on the right side are for more longer-term goals. Those buckets offer higher growth opportunities, but require taking on more risk. The first bucket, this is your spending money. This is the money you need to have on hand to pay your bills and support your lifestyle. It should be in a checking or savings account where it's fully liquid and accessible. For working adults, this account's where your paycheck goes. And for retirees and those living off their portfolios, this is your cash position. For people no longer working, we recommend holding 1 to 2 years of living expenses in this bucket. We often refer to the second bucket as your rainy day fund. It's money you may need in the next few years for a specific expense like a home remodel, new car, or overseas trip. And this bucket also serves as an emergency fund should something unexpected occur. Since this money doesn't need to be as liquid as the first bucket, it may be invested to earn some interest. Now, you don't want to take unnecessary risks, so CDs, short-term bonds, or high-yield savings accounts are appropriate examples of what might fall into this bucket. The third bucket are your retirement investments. This is the money you will need to draw on for your living expenses and lifestyle needs once you retire. These funds are long-term in nature and in reality often need to last for 30 years or longer. So to outpace inflation, this means this bucket should be invested for long-term growth. These investments typically have daily liquidity, and for our clients, your Allodium diversified portfolio would fit into this bucket. The saying goes, the greater the risk, the greater the reward. The fourth bucket is for those who have achieved financial security in their first 3 buckets and have additional money they can afford to invest aspirationally. This is money you can afford to lose and are willing to delve into less liquid, more high risk, high return investments. Examples may be a startup company, a rental property, or a concentrated stock position. Now that we understand the bucket framework, let's define some terms around responsible investing. The first term that you may be familiar with is SRI, an acronym which stands for socially responsible investing. This term covers investments that are considered or avoided due to the nature of the business they conduct. Common examples in the environmental arena may be to favor green or sustainable companies while avoiding companies that are heavy polluters. In SRI investing, achieving competitive returns is important, but it must be balanced against principles. The goal is to generate returns without violating your social conscience. There has been an explosion of new SRI vehicles in recent years. These investment vehicles are typically very liquid, which makes it very easy to implement and add for investors. A more recent term and strategy is an acronym known as ESG, which stands for environmental, social, and governance. While similar to SRI, there are some subtle differences. ESG is primarily concerned with how environment, social, and governance practices of a company may impact its performance. While there is an overlay of social consciousness, the main objective of ESG investing remains financial performance. In other words, it believes that companies with strong ESG characteristics will do better over time, and that those with poor ESG characteristics may run into problems that will hurt performance. Examples of E or environmental characteristics include excluding pollution or toxins, green building, climate change, clean technology, and water use and conservation. For the S or social in ESG, examples of characteristics include human rights, workplace environment, labor relations, diversity and anti-bias issues, community development, and avoidance of tobacco and harmful products. And finally, the G covers corporate governance. Examples include board diversity, board independence, executive compensation, and anti-corruption policies. Similar to SRI, liquid ESG investment options are everywhere these days. making them very easy to incorporate into investor portfolios. For some clients, they want to focus on one component, such as the environment, and for others, they want their investments to address the entire ESG spectrum. Let's shift gears now to impact investing, which differs in many ways from SRI and ESG investing. While the impact investor may have similar values as SRI and ESG investors, they use different approaches in order to potentially have more of an impact. The Global Impact Investing Network cites 4 characteristics that make up impact investing. The first is intentionality, which is an investor's intention to have a positive social or environmental impact through their investments. Secondly, is that the investment must have return expectations. The investment's expected to generate a return or at least return its capital to the investor. If there was no expectation here, it would instead be considered a gift or a grant and not an investment. You'll notice that these return expectations may be different than those of the ESG or SRI investor. In some cases, the impact investment is only expected to provide a modest return or simply return its capital to the investor. Next are the ranges of return in asset classes. So building on the prior point, these investments can target wide ranges of returns from below market rate to a risk-adjusted market rate. And while ESG and SRI investments are typically very liquid, impact investments are often more illiquid and may include asset classes like venture capital, private equity, or fixed income notes. And the fourth characteristic is impact measurement. Most often investors making an impact investment are doing so to make a difference in their area of concern. Therefore, these investments have a greater commitment to measure and report not just on investment performance, but on the social or environmental performance of the investment. In other words, evaluating the impact that the investment has had. Saul will now share some examples of these type of impact investments.
Thank you, Eric. Now I'd like to talk about some examples of impact investments. Before I do, I want to note that these examples are not investment recommendations. You should discuss directly with your advisor how they and other options may or may not fit into your financial plan. We'll start by looking at bucket 1, used for short-term cash needs. In Florida, the Climate First Bank is planning on opening its first branch later this year. It will have the typical personal and business banking services, but with the mission to positively impact the climate. It will provide loans with environmentally friendly initiatives. These could include wind energy projects, rooftop solar panels, and support of local organic farming. If a dentist wants to build a new office with standard construction, they will still finance the loan. But if the building adheres to environmentally friendly building standards, they'll get a lower rate on their loan. We also have a bank right here in Minnesota that focuses on impact investing. Sunrise Bank is a community development financial institution, or CDFI. CDFIs share a common goal of expanding economic opportunity in underserved communities. They do this by providing access to financial products and services for local residents and businesses. CDFIs can be banks, credit unions, loan funds, or venture capital providers. Sunrise Bank is an FDIC insured bank with savings account rates that are competitive with big banks in the area. Sunrise Bank account owners are able to designate their accounts as part of the Impact Deposit Fund. Account owners still have full access to the accounts, but the bank leverages the funds to make loans that benefit the community. One notable program that they have developed will preserve 600 units of affordable housing in the Twin Cities. They also are part of a program that has helped over 95 100,000 individuals build their credit scores without the use of credit cards. We'll now look at investment options for bucket 2, or short-term fixed income. One of these options is a company called C-Note. C-Note offers a convenient way to invest in CDFIs. C-Note sells promissory notes, which work like a CD. Investors buy a note for a set length of time and are paid interest as well as the principal at the end of the term. C-Note currently offers 30-month notes with up to a 2.5% annual return. The money is used to provide loans to help women and people of color start businesses, construct affordable housing, create jobs, and fund other community-centered projects. Calvert Community Investment Notes are another option to use in bucket 2. These are promissory notes that are offered with maturities ranging from 1 to 10 years. Unlike C-Notes, the Calvert Community Investment Notes allow impact investment throughout the world. They allow you to designate geographic areas where you would like to make an impact, including the Twin Cities. They can also be held within brokerage accounts, including IRAs. I'll now turn it over to Derek to discuss examples of investments within buckets 3 and 4.
Thank you, Saul. As Eric mentioned earlier, the third bucket is typically an investor's long-term investment portfolio. This is the bucket of money that we typically manage for our clients. For our clients who have ESG or SRI investing preferences, we aim to align their investment portfolio with their values as appropriate for their specific circumstances and to the best of our ability. We typically do this by using fund managers that either have an exclusionary criteria, for example, where they exclude stocks in certain industries deemed problematic by the client, or best-in-class criteria. Both of these funds that I'll be discussing under bucket 3 are fixed income bond funds. The first fund here is Access Capital Community Investment, which is a short-term bond fund that focuses exclusively on supporting affordable housing, job creation, healthcare, and infrastructure projects that foster sustainable economic development. Before the fund manager makes any investment, it is evaluated for what type of impact it is going to have on the environment and/or community. A number of projects that this fund manager has invested in are located right here in the Twin Cities metro area. Our next example is Praxis Impact Bond Fund. This is an intermediate term bond fund that designates 1/3 of its investable assets towards positive impact investments, such as renewable energy projects, green buildings, affordable housing, and more. The remaining 2/3 of assets are invested using traditional ESG or SRI metrics. Another unique aspect of this fund is that 1% of the fund's assets are invested in already established not-for-profits to provide economic opportunity for disadvantaged communities around the world. One specific example of an impact investment that this fund has made recently was they purchased $3 billion worth of bonds that were issued by the African Development Bank. The African Development Bank was raising this capital to directly fight the impact that the COVID-19 pandemic has had on the African continent. This was the largest dollar-denominated social bond ever launched. The fourth and final bucket is unique in that not all investors have money in this bucket, as it is usually for more speculative and illiquid investments. Individuals who do make investments in this higher risk bucket are oftentimes accredited investors who must meet certain income and asset requirements. We typically do not recommend these types of illiquid investments to our clients, but we have had a number of our clients approach us with some investment opportunities that would fit into this bucket and ask us for a professional opinion. There's actually an investment bank called Big Path Capital that focuses exclusively on private impact and sustainable investments. What they do is assist impact investment fund managers in raising capital from mission-aligned institutional and ultra-high net worth investors. Oftentimes, these funds will be private equity funds directly investing in sustainable and responsible companies that aim to have a positive societal impact. Our last few examples of our impact investment ideas that you have the ability to make if you are interested in opening a donor advised fund. Donor advised funds means charitable giving today. They offer tax advantages, simplified record keeping, and flexibility in choosing beneficiaries. You can almost think of a donor advised fund as your own personal charitable foundation. There are two examples for making impact investments via donor advised fund. The first organization is called the Venn Foundation. Donors have the ability to open up what they call Venn accounts, which are essentially specialized donor advised funds that allow you to invest in PRIs, otherwise known as program-related investments. PRIs are a unique type of impact investment in that the financial terms of the investment must be below market rate. These accounts can be opened up and funded with as little as $2,500, and the money in the account must be used for program-related investments or granted to qualified charities. Impact Assets is a similar organization that allows philanthropic investors the opportunity to make impact investments in their donor advised fund. There is a $5,000 minimum to open up a donor advised fund with them, so similar but slightly more than the Venn Foundation. Donors have the ability to direct their assets towards a multitude of impact investment options, such as professionally managed private debt and equity funds, individual businesses or nonprofit organizations, or in their turnkey impact investment portfolios, which provide the investor diversified access to managers addressing social and environmental issues. This wraps up our ideas for impact investment. What I would like to do now is summarize the material that we learned today and then bring back Dave Bromelkamp to ask him some questions as someone with personal experience doing impact investing before addressing any questions from the audience. So again, in summary, we began with Eric educating us all on the bucket strategy framework. Then Eric went into detail on the nuances of ESG and SRI investing and how they differ from impact investing. After understanding what the bucket strategy is and how and what makes an investment opportunity an impact investment, Saul and I were able to provide real-world examples of impact investments that individual investors can make in each of their so-called buckets. To conclude our presentation today, Dave will join us again and I will ask him some questions that relate to his personal impact investing experience. So Dave, I want to start off with an easy question for you today here first. How did you first learn about impact investing?
Thanks, Derek. And I'll answer that question, but I also want the audience to know that if they have questions, they can type them in the chat room, and then we'll have hopefully a good list of questions from the audience. I hope in the Q&A that I have here with Derek that I say enough controversial stuff that starts the audience to ask questions in the chat room. But I was thinking about, you know, as we were doing this presentation, like how I got started in impact investing or how I learned about it was I about 10 or 11 years ago, I went to a conference in Colorado called SRI in the Rockies. And at that, and I went to the conference because I wanted to get an understanding of the overview of socially responsible investments and particularly specific actionable ideas that I could bring back to Allodium and share with clients, because we had clients that were asking about building more responsible portfolios. And so I went there with a mission to come up with some ideas. And the most important thing that happened at the conference is I met a man named Ron Cordes. And Ron had just sold his business for about $200 million in cash. So he had like $200 million that he had to invest. And what he did is he decided that he was going to build up a responsible investment portfolio. And in particularly, he really wanted to have high impact, high social and environmental impact in his portfolio. And he and I talked for about half an hour. And one of the things he did, we were standing in the conference ballroom where they had maybe 75 different booths with different vendors talking about their money management firms and all the different types of investment ideas and different socially responsible investment specialties. And I said something like, well, do you do any investing? Do you do any impact investing or any responsible investing? And he basically turned around with his arm and he said, I do all that. I go, oh, he goes, all my money is in this room. And I went like, wow, that was like a pretty simple way for him to explain that there's lots of opportunity to be a responsible investor. And there's a lot of opportunity, there's a lot of solutions. And here's a guy that when he decided he wanted to be a responsible investor and he had a lot of liquidity, he decided to go all in and really have a lot of impact with his money, because he knew that he and his family, they wanted to really have a positive impact with the money. They set up a foundation that also was a responsible investment vehicle. And he's been a real big thought leader in the responsible investment space over the last maybe 10 to 12 years. So that his philosophy about using his money to make the world a better place resonated with me. And I started to think about how I might do that myself. Now, I wasn't as quick to the trigger as he was, where he took hundreds of millions of dollars and built a high impact portfolio. For me, I was like, okay, let me get my feet wet. Let me dip my toe in the water here a little bit. Because to me, a lot of these investment vehicles and investment managers were new to me, and I had to get my mind around, how did this work? And did it also fit into a very disciplined investment approach, which is very important for us at Allodium. So that's kind of how I learned about it, was at an SRI in the Rockies conference. I think it might have been 2009 or 2010, probably 2010, because one of the things that is also an idea that is really important is, this was after the 2008 Great Recession, where the S&P 500 had gone down 50% in 1 year. And a lot of people were kind of like bruised after that, bad fourth quarter, and a lot of big companies going bankrupt in the fourth quarter of 2008. And one of the things that Ron said to me is, he said, you know what? He goes, my portfolio didn't go down in the Great Recession. And I said, well, how does that work? And he kind of made a comment that he said, if you're buying, let's say, if you're in a microfinance fund that pays you like a 4% interest rate on your microfinance, he goes, if the S&P 500 goes down 50%, you still get the 4% interest from your microfinance fund, because the microfinance fund really has no relationship to the S&P 500. And so when you're building an impact portfolio, some of it's different investments from what are traditional investments, not always, but sometimes you're going to get into more illiquid investments, and sometimes you're going to get into maybe higher yielding investments or lower yielding investments. But he had built out a portfolio that he could confidently say to me, he didn't really get negatively impacted by the fourth quarter of 2008 when we experienced the Great Recession. And, I kind of looked at that and I said, it's a different way of investing, and it may have actually different behavioral aspects than a traditional investment portfolio. So that's kind of a little side comment I'd make on Ron Cordes.
Yeah, that's very interesting. And it sounds like, 2010, around that time when you first heard about this, that was kind of at the forefront of kind of the ESG SRI investing that really wasn't becoming mainstream yet. And impact investing at that time, I know was pretty not very well known. So it's kind of interesting to hear that you were on the forefront, with your talks with Ron. Now, why are you interested in making impact investments?
I think that a couple of years ago, I kind of came to the conclusion that when Eric was talking about the bucket strategy, for a lot of Allodium clients, we're building them a broadly diversified portfolio, primarily to provide them with the financial security for their retirement years. So we're building a long-term portfolio, broadly diversified. You know, we have confidence that that's going to be money that's going to be available for their retirement. And a couple of years ago, I kind of looked at my situation and I said, currently I'm 60 years old. And I said, I think I already have enough in that third bucket to provide for my retirement. So what should I do next? And a lot of times when people kind of get emotionally comfortable that they've kind of got the big retirement package set up for them, they kind of think about a couple things. One is sometimes people become more philanthropic and they give more to charity. Other people start earmarking some of their assets for the next generation, and they want to either give money to their kids now while they're still alive, or they want to leave money to their kids when they die. And the third idea is, as your wealth continues to grow and you realize that you have some kind of excess capital, one of the things you can do is say, I'm going to take that excess capital and I'm going to invest it in a way that's going to have high impact. And so while me and my wife are charitably inclined and we give money to charity, and we have 3 kids and we want to try to help our kids financially and get them all set up, this idea of being an impact investor is to say, what can I do to use my capital today to help make the world a better place by looking at things that we care about and that we value, and we want to get our investments in alignment with our values and have high impact. For me, when you ask me about like my charitable giving or my impact investing, one of the things, or one of the values that I have, is I believe that education is something that is critical to kind of lift up everyone in society. And there's a lot of people that if they're living a tough life, a lot of times it might be because they didn't get educated at the right time in their life, or whether it's kindergarten, 5th grade, 12th grade, college, MBA, PhD, this education is always good. And so to me, when I start looking at putting my money to work, either through charitable giving or impact investing, the idea of education becomes one of my core themes. And so as I realized that I wanted to use some of my capital to be an impact investor, I had to start looking outside of the normal Allodium diversified portfolio, which we know how to do well at our firm. But this idea of having different buckets where I could either take less risk in bucket number 2 or more risk in bucket number 4, I don't need to put more money into my third bucket because that's all taken care of. I need more money into the bucket 2 and bucket 4. Once I started thinking like that, it opened up the opportunity for me to make a lot of very unique investments that are very high impact. So
yeah, and I think a lot of people would agree with your statement, Dave, that giving everyone educational opportunities is one thing that can really lift people into better economic situations. Can you think back and remember what your first impact investment was?
This is actually, I think about this 2 ways. The first impact investment I made, I did it unconsciously. And so I'm going to give you 2 answers here. The first is I invested in a company that recycles contaminated gravel back in 2000, I think about 2003. And the reason I looked at it is I said, the world needs to be able to recycle all types of materials. And so I'm a very big believer in recycling technologies. So I made that investment in 2003. It's a profitable little company, kind of unique, but some big firm will probably try to acquire them someday because they've got a good recycling technology. But I did that not understanding what I was doing at the time. The first conscious impact investment I made is when I was at that conference in 2009 or 10, that SRI in the Rockies conference. I bumped into a woman by the name of Donna Katzen, and she had started a nonprofit called Shared Interest. Shared Interest is an organization that helps low-income farmers in South Africa to get bank loans. And the way it works is the typical poor farmer or low-income farmer in South Africa, if they need $500, if they need to borrow $500 at the bank to get their crops out, harvest their crops or plant their crops, they go to the bank and the bank says no. That's just the way it works. The bank doesn't want to loan you money unless you already have money. So if you're a poor farmer or a low-income farmer in South Africa, it's really hard for them to borrow money. So Donna Katzen at Shared Interest came up with this idea about why don't we put together a guarantee fund that, when what Shared Interest does is they buy like US Treasury bonds and they put them in the bank in South Africa, and they use that as collateral to give the banks the incentive to make loans to these low-income farmers. And so I looked at that and I said, that's actually it's a pretty sophisticated idea, and it accomplishes the goal of kind of creating cash for the farmers when they need it. I chose this as my first investment, my first impact investment, because it was three things. It was very low risk, because it's basically just US Treasuries in a bank in South Africa. And they've not lost any money since the inception of their organization over 37 years ago in 1994. So being kind of a sissy investor that doesn't like to lose money, I thought this was a pretty safe to dip my toes in the water. The return is low, and it's about maybe 1.59% is the return I get on this investment. But it's kind of like similar to what the US Treasury bond, the 10-year Treasury is probably paying that right now, 1.6%. But the impact is really high. So if you think about this, if the typical farmer wants to borrow $500 from the bank, if I buy a $10,000 note from Shared Interest, I can help 20 farmers get a $500 loan from the bank. If I invest $100,000 in the guarantee fund, I can help 200 farmers get a $500 loan. And if I invest $1 million in the guarantee fund, I can help 2,000 farmers in South Africa to get a $500 loan. Because the common denominator is they all need the $500 loans. All the farmers need these relatively, we would think relatively small loan amounts, but the banks they didn't want to make these loans unless they were guaranteed that they wouldn't lose money. And so it's kind of that was my first impact investment. I get a return on my money. I'm probably not going to lose my money because nobody's lost money in the fund in 37 years. So I think it might be kind of a relatively low risk investment. And the impact to me is really high. And when you think about why the impact is high, is that if I have $10,000 in America, well, that doesn't really seem like a lot of money to us because a lot of people have $10,000 in America. But in South Africa, these poor farmers don't have $10,000. They're trying to borrow $500. And so, and some of the investors in the Shared Interest are nonprofit organizations where it's really easy for them to give Shared Interest $1 million. And they get they give $1 million to Shared Interest. They make their 1.5%, and they know they're really having high impact because their $1 million is facilitating 2,000 loans to low-income farmers in South Africa. Really high impact. And that is, if you consider impact, high impact be defined as helping poor farmers in South Africa. Some people might not think that's high impact. I do, even though it's not my focus, because this was a relatively safe investment and I could understand the idea of these guaranteed collateralized loans. To me, it was like a really simple first impact investment. So that was my first conscious impact investment, shared interest.
Yeah, that sounds like a really interesting investment opportunity. And I think it's a great example of showing, how far reaching your money can go with some of these impact investments. South Africa, that's a long way away from here from Minneapolis. So Dave, can you think about, what maybe comes to top of mind as maybe your most interesting impact investment, or one that, you were really excited about to tell people at a cocktail party?
Yeah, the idea that kind of my most interesting impact investment just showed up about 2 years ago. And this was a bucket 4 investment, which is high risk, illiquid, might work, might lose all my money. But I was introduced to Warren Buffett's grandson, Howard Buffett, a few years ago. And he was establishing a new company, a new holding company that he, is similar to Berkshire Hathaway, in that they're going to be a holding company that goes out and buys, let's say, 50 companies. Not a mutual fund, not a money management firm, but a holding company that's going to invest in about 50 companies. This company is called IX Investments. And the interesting thing is, the simple way to describe it is, Howard Buffett, who is Warren Buffett's grandson, decided to set up a company just like Berkshire Hathaway, but with a social impact lens. And so all of the companies they want to invest in are going to be things that deal with environmental issues, could be social issues. Just think about ESG as, environmental, social, and governance issues. And their goal is to become the first publicly traded impact investment company in the United States. And when you think about, millennials are really interested in impact investing. The problem with impact investing is there are thousands of ideas, and it's kind of hard to go out there and look at the world and try to figure out, of the thousands of ideas that are applicable or available, which ones are really applicable to your situation. Are they liquid? Do they meet your particular focus for impact? Do you trust the management? Are they going to make it? Are they going to go bankrupt? There's just a lot of issues that are just normal investment issues. But if you think about this, and this is kind of, I almost immediately wanted to become an investor in the company, because I understood what's going to happen is, if they go out and they invest in 50 good companies that have a social impact lens, and they go public in 5 years, there are millions of people that are going to want to buy shares in that company when it's publicly traded. There are millions and millions of people that are going to want to buy that if it does go public and becomes a publicly traded company. Personally, I've watched the growth of socially responsible investing over the last 20 years. I've watched it accelerate over the last 10 years. And now it's almost like become like a red hot topic. And in the area of responsible investing, the idea of high impact investing is even a more interesting topic. And there's a lot of interest in impact investing. And what people are trying to do is bridge the gap and try to figure out how can they take their money and build an impact portfolio. And so this IX Investments, which is in the 4th bucket, I'm personally not looking to make high risk investments in my 4th bucket. This just kind of like, I bumped into it and immediately it was a very appealing idea to me. So that's been my most interesting investment. And if you give me a beer at a cocktail party, and I'll bend your ear for 20 minutes telling you about how great this is. I think there might be less than 50 investors in the company because it's a private company and it's illiquid. But that's kind of my most interesting impact investment to date. And I didn't find it by looking for it. It just showed up on my doorstep, and I said, great, this is exactly what I was looking for, even though I wasn't looking for it.
Yeah, and I think a lot of investors would love to invest their money alongside Warren Buffett. So Dave, next question here. I think I know the answer to, but do you use the bucket strategy for your own personal balance sheet?
Yes. As I said earlier, my traditional Allodium portfolio is my third bucket. And I would say my third bucket is full, and it's going to provide for what I need. In fact, that's what my Allodium financial planning team tells me, is that I've kind of taken care of my retirement goal need. And so now I can be more aspirational with my capital, or more philanthropic, et cetera. So the second bucket would be things like that shared interest that pays 1.5%. Mostly in the second bucket, you're going to be trying to get a return somewhere between 0 and 5%, or 0 and 4%. I mean, the returns are not going to be high from relatively safe and relatively liquid investments. You're going to be getting, interest type returns on kind of like bond type of notes. Shared interest is a note, as I said, 1.6%. Another one that I looked at is, and I actually own, is the Calvert Community Notes, which pays about 2% and allows you to tell Calvert where you want them to use the money. And so I can say, I want you to focus on impact in the Minneapolis area. And so they'll take that money and maybe they'll earmark that for affordable housing, or making loans for affordable housing in Minneapolis. That's an example of the Calvert Community Notes. Calvert's a kind of, as a brand name, it's I think a very safe brand name for someone that's an impact investor. And if you do look at impact investing, you're going to run into the Calvert name pretty often. Another relatively new idea is, I think Saul mentioned the C note. The C note is I'm in the C note flagship fund, which pays 2.5%. Again, these are notes that are a couple years. They're like 2 and 3 year notes. And that puts money out to community development financial institutions. They call them CDFIs. A couple other things I'm looking at are a microfinance fund. Invest pays about 4 to 5%. And Iroquois Valley farmland notes pay about 2 to 3%. So I'm kind of looking at additional ideas in that second bucket, trying to get returns that are in the 2 to 3 to 4% range. Then, as I said, the fourth bucket is the IX Investments. That's Howard Buffett's company. The recycling company I invested in 2003 would be in that bucket because it's illiquid. Potentially the company could go bankrupt. It's not a diversified holding. It's a single company. There's some other things that the one idea that I'm working on here is I believe that with the decline in interest rates and low inflation over the last 10, 20, 30 years, we could be at an inflection point where, with all of the money that the Federal Reserve is pushing out into society, we think that inflation might not be going down in the next 5 years. All of this cash could have inflationary pressures. So real estate is probably something that might be an investment that would do well in a inflationary environment. And so what I did is I started thinking about that, and then I started thinking about farmland, because farmland pays income when you rent it out. You rent your farmland out to a farmer, they're going to pay you cash flow on that. Kind of a solid investment. But then the idea of high impact is, what about investing in organic farmland? Because it seems to me like more and more people are interested in organic foods, and it doesn't seem to me like there's an awful lot of farmland that's focused on organic farming. And so this would be an idea that I'm looking at, and I'm saying I would like to own organic farmland because I think real estate is a good idea. I think farmland is a good idea. It's an income. I don't have to like rent it out to a renter that may or may not pay their rent in an apartment, but this is just farmers, you know, that are leasing your land. So the income is probably pretty predictable. But then the biggest issue is, do you believe that the demand for organic farming will be going up or down in the next decade? And I would have the prediction or the guess to say, I think there's going to be more and more demand for organic foods and organic farming in the next decade. And so owning organic farmland could be a pretty good long-term idea over the next 10, 20, or 30 years. And so I've been doing a lot of investigation in this area. I've identified 4 companies that probably would be interesting ideas: Iroquois Valley Farmland, DST Farms, Stewart Farm Trust, and then Farmland REIT. Then to kind of close out this idea about farmland is, little side joke is, I think most of you know who Bill Gates is. And Bill Gates is the largest farmland owner in the United States. And he owns 242,000 acres. I don't know if you know, that's a lot of land. It's a lot of farmland. And so there are billionaire buyers of farmland. And I think they see it as a pretty good store of wealth. They understand it's an income producing asset. And they also think that it might be an inflation protected asset going into the next 20 to 30 years. So that's my little, if Bill Gates is doing it, it might be good for me too. So I'm doing an investigation on the farmland idea. And another idea in the 4th bucket that I'm also looking at, and it's a local idea. I haven't done my due diligence, but what I'm going to literally do is go to the facility and meet the president of this company. But there's an affordable housing project being developed in Minneapolis, in North Minneapolis, called Satori Village. And if you want to have high impact in Minneapolis, building affordable housing in areas that need good quality affordable housing, to me, that would be high impact. And so I'm going to investigate that. Also kind of on my theme of, a lot of people have a hard time investing in real estate because they don't understand how to do it. They don't know how to manage properties. I personally don't want to manage any real estate. If I invest in real estate, I want somebody else to manage it. And so the only things, I only want to invest in things that are simple, because I don't want to complicate my life. But I do want to have exposure to sectors of the economy that are going to do well for me, because I still want to grow my assets. Impact investing is not about losing money or getting low returns. Impact investors should get market returns. You should be able to figure out how to get market returns. And so if you go back to the bucket 2, and I was talking about returns of 2 or 3%, well, that's the kind of return you get on safer money. You know, that's a market return for safer money. High risk money, you probably shouldn't be investing in things unless you're going to get a significantly higher return than a diversified portfolio. So if we talk about Allodium portfolios having expected rates of return in a diversified portfolio of 6, 7, 8%, if you're going to go into the 4th bucket, you better have an expected return of better than like 10%, because you're taking a lot more risk. So your investment goal in that should maybe be 15 or 20%. You should have high expectations because you're taking a lot more risk in that 4th bucket.
Great, and I think that's a great segue for the next question here. But I do want to point out the that Bill Gates may not own that amount of farmland once his divorce is finalized with Melinda. So, but I think staying on the path towards returns. Obviously everyone invests to get some sort of financial return. What type of returns have you personally expected from some of your impact investments that you've made?
Yeah, as I said, in the bucket two, if you look at it long enough, you're going to realize that everybody wants to pay you like 2 to 3% on the safer money. So don't expect 5, 6, 7%. It's just not available. And this is mostly like 2 and 3 year notes that will pay like 2% or 2.5%. The bucket three, which I said is typical Allodium portfolios that are broadly diversified, you've got your expected returns to be, depending on how much you have in fixed income, those are going to be in the 6 to 8% range. And then in the fourth bucket, probably, I would say your range could be like 10 to 15% would be like a good target expected rate of return. And you shouldn't invest in the fourth bucket unless you think there's an opportunity for you to earn a 10 to 15% rate of return on that investment.
Right. And do you prefer to invest in any specific geographical areas?
I personally don't have a geographical focus, whether it's what continent to invest on or what country, or whether I want to do it local or in Latin America or whatever. If push comes to shove, it really typically it makes people more comfortable investing in their own backyard. So if I can invest in like real estate in North Minneapolis or South Minneapolis or in the Minneapolis area, or any kind of investment I can make where I can like drive by the organization or drive by the business, that to me would be kind of comforting. And I think everybody might be wired that way, to feel more comfortable when they can see and touch the investment that they have invested in, and or to be able to like meet with the managers of the investment that you've invested in. The flip side of that is, as I use the shared interest example of South Africa, helping low-income South African farmers, the impact that I can have with 10,000 or 50,000 or 100,000 is absolutely huge, because that is so much money for these low-income farmers. And I can help 20 of them or 200 of them or 2,000 of them. The more money I put into the fund, the more impact I'm going to have. And so to me, I didn't necessarily go out looking to invest in South Africa, but that's where the people that are going to be impacted the most, that's where they live. And when you look at just the whole continent of Africa, you're going to find that your investment dollar is going to have high impact for a lot of different issues. So I'm kind of doing both. I would like to invest in my community in Minneapolis or in the Twin Cities or even Minnesota. But when I see that I can have really high impact in Latin America or Africa or in some parts of the world where there's a lot lower income level, my dollar can have a lot bigger impact in those parts of the world. So I'm kind of doing both. I don't really have a particular preference for a specific geographical area. Some people do. Like my brother Henry, he loved going to Africa and build schools in Africa. And so for him, that's still his kind of his big charity, is to help, people in Africa. Again, with education, he's been involved with things like Books for Africa and things like that. And so everybody develops their own both philanthropic goals, and sometimes the impact goals are directly correlated to their philanthropy.
Great. And kind of speaking of aligning kind of your impact investment goals with your charitable giving or philanthropic goals using your donor advised fund, do you use any donor advised funds?
Yes, I have 3 donor advised funds, and the donor advised funds kind of allow you to combine your philanthropy with high impact investing. And the three donor advised funds that I own, the first one is the Schwab Charitable, of which I can have mild impact with using socially responsible and sustainable investments in a daily liquid diversified portfolio. So that's my first donor advised fund, and I primarily use it to be to kind of make the administration of my charitable giving more efficient. It simplifies my life, makes my life easier. The second donor advised fund I set up is at the Catholic Community Foundation. And for me, as a Catholic, I want to support Catholic grade schools and Catholic churches, et cetera, and Catholic charities. I'm on the investment committee there. So I use the Catholic Community Foundation to kind of align with my Catholic values, kind of my religious core values. And then the third foundation, or the third fund I set up, the third donor advised fund, is a very unique organization called the Venn Foundation. And this is where an investor can make program-related investments where you can choose a specific nonprofit organization to support. And I got to use it as, I'll use an example, because this is like, to me, hitting the nail on the head like 10 times in a row relative to how it lines up with my philosophy of life. There's an organization called the Minnesota After School Advance. And what it does is it helps low-income families take advantage of the Minnesota Education Tax Credit. And so I'll explain this, that a family in Minnesota, think like the single mom with 3 kids in grade school. And the state of Minnesota says, we'll give you $1,000 for each of your kids to take advantage of this Minnesota Education Tax Credit. So you go out right now and you spend the money on, let's say you buy iPads for your 3 kids, and then you buy them a bunch of software, and then you buy them some books or whatever, or you put them in a soccer camp or whatever. You take $1,000 for each of your kids, and then if you do this, we'll give you a tax credit of $1,000 on your tax return next April. Well, the problem is the single mom with 3 kids doesn't have $1,000 to buy an iPad for their kids or send them to soccer camp. They don't have the $1,000. They surely don't have $3,000 for their 3 kids. And so they don't take advantage of the tax credit. So the $1,000 that the state of Minnesota wants to give them, they're not taking advantage of the program. So somebody set up a program-related investment called the Minnesota After School Advance. And so what I'm doing is I can put money into this Minnesota After School Advance. Let's say I put $3,000 in the fund. I think the minimum might be $5,000 or something, but let's say you put $3,000 in the fund. That's going to allow one mom to get $3,000. She borrows the $3,000 out of the fund. And then when she does her taxes in the spring, she gets the $3,000 back, and that's paid back to the fund. And so inside of my Venn account, I have a little sub-account called Minnesota After School Advance. And once they pay the money back into the account, the money goes back into my account, and it can be recycled every year into infinity. And so this idea of the Venn account is, what you're really doing is you're providing capital for program-related investments. to help nonprofits to achieve a number of different objectives. Right now, I think I have 5. I have 5 right now. My 6th one is coming up. It's going to be a recycling company that needs to borrow some money. And so I kind of like recycling is something that I kind of think I want to support. So I'm committed to going in and supporting this PRI for this recycling company. And what they do is they might borrow the money for 5 years and pay 2%. And then in 5 years, they pay the money back into the account. And so my money is always there. They're just using my money in my account. So my donor advised fund, instead of the Schwab fund where I put money in and then it gets distributed out to charities and the account value goes down, in my Venn account, people are using the money that's in my account and then they pay it back. And so my account value typically isn't necessarily going to go down. It might be going up over the next decade. And I can always take the whole account and just distribute it to one charity whenever I want to. But what the Venn account is allowing me to do is support a lot of charities that need financial assistance, typically short-term loans, and relatively low risk, and the money gets recycled so I can turn around and help more nonprofit organizations in the future. So that's my 3 existing donor advised funds. And the 4th one I'm actually considering is the Impact Assets Donor Advised Fund, which is probably the most progressive impact investment donor advised fund in the country. And that was spun out of Calvert Impact Capital a number of years ago. And they have what they call an Impact Assets 50 list, where they come up with a list of like the 50 best impact investments every year. And so if you're looking for ideas, that Impact Assets 50 is kind of a really great starting point for looking for impact investments. And as I'm toying with the idea of starting this 4th donor advised fund, and I think it's inevitable that I'll do it. It's just a matter of I can't do everything every day, so some stuff gets set off to the side. But that to me would be another really good opportunity for a donor advised fund that would be investing in impact investments.
Yeah, I love that story of the program related investment that you told in the Venn account that helped kind of those single mothers, low income mothers with gaining access to that tax credit that they wouldn't have. That's just a really great example of how locally your money can make an impact. So Dave, we got a few more minutes here, and I know we have a couple questions from the audience. So this is going to be kind of my last question I have for you. But how can other individuals get started with impact investing?
The way I would do it is, start with holistic financial planning that kind of looks at your whole personal financial statement or your whole balance sheet as a source of funds for impact investments. And using this idea of the bucket strategy is to kind of help you think about what are some potential sources of funds that you could use for impact investing. And in our wealth management bucket, we have 4 buckets, and they're basically from like really safe to really aggressive. That's kind of how the 4 buckets are set aside. If you want to have a 5th bucket, it's not a linear process. The 5th bucket is actually the donor advised funds, which is really not a balance sheet asset for you, because once you put something in a donor advised fund, it's no longer on your personal balance sheet. You've given it to charity. But that's like a satellite 5th bucket to be considering. And you could start by looking at any of those potential 5 buckets for starting. What I did is I said, let me start with the safe bucket number 2. I don't want to lose the money. I'm kind of a sissy investor. That to me would be the first place I would start. And then what you have to do is define your impact themes of interest, whether it's, do you want to do microfinance or affordable housing, protect the environment, issues like equality, diversity, social justice. You figure out what it is that you care about, what are your values, what are you passionate about, and try to, instead of looking at thousands of investments with no screening tool, if you take thousands of investments and you say, well, I'm just going to look at affordable housing and see what's available there, instead of thousands of ideas, you might see 50 ideas. And what you're doing is you're simplifying your search process. So defining your impact themes of interest, I think, is the first thing you want to do. Second thing you would do is maybe define your geographical preferences. Again, you want to invest in Minneapolis, Minnesota, the Midwest, the United States, Africa, Latin America. You can decide that, because that will help you kind of focus in on a limited number of investments, and you don't have to try to analyze 5,000 different impact investments. You might want to look at a list of 50 and then kind of like focus on that list. A caveat is also think about income tax reporting. I like 1099s because the 1099s usually come out pretty quick in the, at the end of January. I get them in February and I can do my tax return. Some investments have a K1, of which they always promise you that they're going to give you the K1 in a very quick period right after, when you're supposed to do your taxes. But some organizations, just because of the way they're set up, it's very difficult for them to get their K1s out in time for you to do your taxes by the April 15th deadline. So before going into an investment with a K1, make sure you're comfortable that you might have to extend your tax return every year, waiting for that K1 from that investment that you thought it was a great idea, but you didn't realize you were going to have to extend your tax return every year. So that's one thing, to just a caveat, is the income tax reporting. And the other thing that I think simplifies your life is try to identify investments that you can hold in your existing custodian. I own the Calvert Community Notes, and it's on my Schwab statement. And that is a good thing for me. It's actually even a good thing for my financial advisors because they can see my investments in my Schwab brokerage statement. Schwab, Fidelity, whatever, whoever you use as your custodian, if you can make impact investments that you can keep on your current custodian statements, that will simplify your life. It kind of eliminates some of the complexity. And so I would recommend that you consider whether the investment is available to be held at your normal custodian.
Great. Well, thanks, Dave. Before we go ahead and answer any questions from the audience, is there anything else you want to add here, Dave?
I just, kind of look at what I did. If I have this idea pop into my head when Ron Cordes told me about it like 11 years ago, 10 or 11 years ago, I've been on a multi-year journey. And I've been making progress every year, but I only make a little bit of progress every year. But I'm going in a certain direction, and I kind of know where I'm going longer term, and I'm learning as I go. And, maybe I'm even learning by making mistakes as I go along the way. Hopefully they're all just small paper cuts, but what you got to think of this as a multi-year journey that you'll be on probably for a long time. And I think that it will be an interesting journey because I do think the world is changing, and that the investors who are what I would say responsible investors who want to build out responsible portfolios and they want to have high impact with some of their money, this is like where the world is going, and it should be getting easier for impact investors as we go forward, because there are an awful lot of people that are interested in impact investing. Where they run into roadblocks is it's not easy to just implement by pushing a button. There's work involved, and some of it is you have to think about what your core values are and what you're passionate about. and then go out to the world and try to find those ideas. But think of it as a longer term journey. And I think that it's really rewarding. If you really are passionate about certain things and you do have some well-defined values that you really want to invest the money in alignment with your values, that there's a lot of opportunity, and you can do, there are people doing a really good job with impact investing. So we know it's not impossible, but it is a long journey and it's an interesting journey. And I would highly recommend that if people want to be impact investors, that they kind of just commit to learning more and to taking baby steps to move in a certain direction.
Well, that's great, Dave. Thank you so much for that insight on kind of the impact investing journey that you personally have been on. I see we have a few questions here in the chat from the audience, so I'll go ahead and read the first one. And the first one is, what is the difference between charitable giving that impacts local and grassroots functions and impact investing? I think this is a great question. Essentially, it's asking, what's the difference between charitable giving and impact investing? And really the main difference between those two is with impact investing, there must be a financial return. So when you think about some of the investments that Dave mentioned that he invests in, there's a financial return that he gets. And then when he gets his money back, plus any financial return, he's able to recycle that money back into more impact investments. Whereas when you think about, just traditional charitable giving, you give, $10,000 to a church or a charity and it's gone. It's now in the hands of that specific charity. So kind of the unique and the main difference between impact investing and charitable giving is with impact investing, you're able to recycle that money into more impact investments. Dave or Eric or Saul, is there anything you guys wanted to add on that front?
I can give you an example, a real life example that would help you with this. I'm involved with a new company called the Center for Board Certified Fiduciaries. And it's a startup that started last year. It's got about 35 co-founders. And it's going to be putting together fiduciary training for financial advisors and lay fiduciaries. It's also going to be developing an MBA program on fiduciary responsibilities, with eventually trying to have a PhD program on fiduciary duties. So it's a really big project. It's a very ambitious project. And what I suggested to the CEO is it's a for-profit company, but it's a public benefit corporation, which their goal is not only to make money, but it's to improve society and make the world a better place. And so they would qualify for, if I wanted to set up a program related investment through my Venn account, I could go to the Venn Foundation and say, I want to provide $200,000 for this startup. And this is literally what I proposed to the CEO. I said, I'll give you $200,000 on a no interest note for 10 years. And then you pay me back the loan into my Venn account in 10 years. You give me the $200,000 back. And what that would do is it would provide this public benefit corporation, the Center for Board Certified Fiduciaries, it would give them $200,000 for 10 years to help them to get the company up and running. And with no interest, they wouldn't have to pay any interest. All they'd have to do is be comfortable with the fact that if they're successful in 10 years and they have an MBA program at, let's say, Yale, and they're making boatloads of money because everybody in the world wants to take these courses, they'll obviously have the ability to pay back the $200,000 loan in 10 years. And if they pay the loan back in 10 years, that money goes back into my Venn account, and I can take that 200,000 and use it again for another program or another program related investment that the Venn account people have put together, or that the Venn Foundation has put together. So the idea of recycling the money in your donor advised fund, that's one way of recycling it. The other idea is if I make an impact investment, let's say I invest in Howard Buffett's company, IX Investments, and they go public in 5 years, and then I sell my stock and it's gone up 5-fold, I'm going to be able to recycle that money into other impact investments. And so the difference is once you give to charity, it's gone to charity. You've made your decision to be a philanthropist. The impact investing is literally about you're investing with the expectation of a return. You're expecting you're going to get your money back, and you're going to be able to recycle that into more impact investments in the future. I'm doing both. I'm doing the charitable giving, and I'm also doing the impact investing. There is a little bit of there's not a big hard black line between the two. Some things they look very similar, but I'm doing both at the same time. And I think most people that are philanthropic will understand impact investing a little bit. And final thing on the Venn account or the Venn Foundation is, if you have a nonprofit that you want to help and you say, I'm willing to give them $10,000 this year as charity, but I really, they need $500,000, for a building project for the next, 10 years or something. You can go to the Venn Foundation and say, I want to set up a program related investment for my favorite charity to help them to get the $500,000 they need, or the million, or the 5 million, or the 10 million. And they'll put together a program related investment. They'll attract a group of donors that will fund that program related investment. And you can potentially help your nonprofit to get the money that they need to build their new building or to put together a new program. One of the things that I invested in my Venn account is the Minnesota Children's Museum wanted to borrow $200,000 for a traveling program. And so I thought that was a good idea. So I invested some of my Venn account in a loan, a program related investment for the Minnesota Children's Museum, which I think that's a pretty reputable organization. And I think they're going to pay their loan back. They'll probably make a lot of money on this traveling exhibit that they're going to have. They'll pay back the $200,000. I get my money back into my Venn account, and it's going to be recycled again to another charity in the future. So a lot of opportunity there.
Yeah, very, very, very well said, Dave. And our second question here, second, I believe, last question is another good one. And it asks, what are the best instruments that give you the freedom to make an impact for the needs at a more local or regional level? And I think I can take this one first, because I think a great example of this is when you think about the CDFIs that Saul talked about early on in the presentation. Essentially what a CDFI is it's a bank or a credit union that primarily serves underserved communities. And we gave that one example of Sunrise Banks, which is right here in the Twin Cities metro area. And when you think about what a bank does with your deposit, is it just recycles that deposit back into the community. So the easiest way to ensure that you have a local impact is opening up, a CD or a savings account with a local CDFI. That would be probably the easiest way to go about doing that. And Dave, I know you mentioned some of those PRIs that you have made that are primarily here in the Minneapolis, St. Paul area as well.
Yep. Yeah, it's going to come down to trying to quantify your passion for certain philanthropic themes and or impact themes, along with your preference for local versus distant. And there isn't a right answer. That's kind of a balancing act. Every individual investor kind of makes their own decisions. And a lot of times an advisor like Allodium, we don't direct people in a certain way. What we do is we ask questions to try to help people get to the right answer. And I always say a good financial advisor is someone that asks good questions so that an investor can kind of get to the answer that they're looking for, to get to the right answer. And so we try to know an awful lot about impact investing or responsible investing, with the idea that no matter what your core values are, and no matter what your socially responsible investment preferences are, our job is just to figure that out by asking you questions, kind of surveying your value system and what you're passionate about, and then try to help you implement in a way that makes you feel like, and with impact investing, almost every impact investor says, I want to use my money to make the world a better place. And our question to that always is, what does making the world a better place look like to you? Like, how are you going to make the world a better place? Everybody answers that question differently. Some answers are similar, because there might be a lot of people that care about the environment, or a lot of people might care about diversity or whatever, but everybody's wired individually and everybody has their own core value system. And so a financial advisory firm like Allodium is just to try to help people by asking questions to get them to the right answers. So, but with Eric, I think we're right at 11:30, 11:32. So I'm gonna thank everybody for attending today's webinar. We hope you found the session to be a productive use of your time. And please let us know if you have any questions that you think of after we sign off today. And with that, thanks, and enjoy the rest of your day, and feel free to follow up with Allodium with any questions that you might have. So thanks.